In this video, we're going to give examples and explain concepts and terms related to savings plans and investments. So just let's look at number one, distinguish between the total return and the annual return on an investment. How do you calculate the annual return and give an example? So the total return is the percentage change in the investment value. The annual return is the annual percentage yield that would give the same overall growth over Y years. The formula is annual return equals, and then in parentheses, A over P, close the parentheses, raised to the 1 over Y power, and then outside all that minus 1. So that is A. Let's give an example here. So an investor has a starting principal of P equals 3,000 and an accumulated value of $8,400 after Y equals 4 years. The annual return is annual return equals quantity A over P raised to the 1 over Y minus 1 would be equal to quantity 8,400 divided by 3,000 raised to the 1/4 minus Y. Minus 1 is going to be the fourth root of 2.8 is going to be minus 1 is going to be approximately 0.294 or 29.4%. That's C. Briefly describe the three basic types of investments: stocks, bonds, and cash. How can you invest in these types directly, and how can you invest in them indirectly through a mutual fund? So stock gives a person a share of ownership in the company. To get money out of the stock, it must be sold. The sale may yield either a gain or a loss, depending on how the stock changed with time. Let's briefly describe bonds. Bonds represent a promise of future cash. They are issued by either a government or a corporation. The issuer pays simple interest and promises to pay back the initial investment plus interest at some later date. And briefly describe cash. So cash investments include money deposited into bank accounts, certificates of deposit, CDs, and US Treasury bills. Cash investments generally earn interest. How can you invest in these types directly? So a person can invest directly, which means buying individual investments on his or her own, often through a broker. Let's see. And then how can you invest in them indirectly through a mutual fund? A person can invest indirectly by purchasing shares in a mutual fund through which a professional fund manager invests the money along with the money of others participating in the fund. So that's D. Explain what is meant by an investment's liquidity, risk, and return, and how are risk and return usually related. So an investment's liquidity is how easily it can be withdrawn from an investment, usually meaning and turned into cash, right? So what is meant by an investment risk? An investment's risk is the chance of losing the principal invested. And what is meant by the investment's return? The investment's return is the total or annual amount of money that is expected to be earned on an investment. And how are risk and return usually related? Balancing risk and return is one of the most difficult tasks of investing. Risking too much might lose some money, and risking too little may result in little to no return. So usually there's this phrase, no risk, no reward. You have to take some risk in order to usually get some return on your investment. Contrast the historical returns for different types of investments. How do financial indices, such as the Dow Jones Industrial Average, help keep track of historical returns? So stocks have historically proven to be a far better long-term investment than bonds or cash, but can do poorly over shorter time periods. They're more volatile, right? Cash has the lowest return rate, but it's the safest investment. How do financial indices such as the Dow Jones Industrial Average help keep track of historical returns? So the Dow Jones Industrial Average reflects the average prices of the stocks of 30 large companies chosen by the editors of the Wall Street Journal. That's D. And then let's define the face value, coupon rate, and maturity date of a bond. And what does it mean to buy a bond at a premium? And what does it mean to buy a bond at a discount? And how do you calculate the current yield of a bond? So the face value of a bond is the price that must be paid to the issuer to buy it at the time it is issued. The coupon rate is the simple interest rate that the issuer promises to pay. The maturity date of the bond is the date on which the issuer promises to repay the money. And to buy a bond at a premium means paying a price that is greater than the bond's face value. Buying a bond at a discount means paying a price that is less than the bond's face value. And how would you calculate the current yield of a bond? The amount of interest a bond pays each year divided by the bond's current price. Okay, let's look at number 6 here. Briefly describe the meaning of key data values given in online quotes for stock and mutual funds. So the stock symbol is the company name, and the ticker symbol used to identify it. The now is the price per share in dollars at the time shown. The shares outstanding is the total number of shares that exists for the company. The market cap is the total stock value of the company. The change is the change in share price in dollars since prior day's close. The open, high, low is the opening, highest, and lowest share prices so far today. The volume is the number of shares that have been traded today, and the dividend is the dividend paid during the last quarter per share. So all that is B here. Then briefly describe the meaning and key data values given in online quotes for mutual funds. This will be C here. The fund name is the full name of the mutual fund. The symbol is the ticker symbol for the fund. The NAV is the net asset value and is essentially the share price. That is the current value in dollars of each share in the fund. The YTD percent return is the total return on the fund shares year to date since January 1st. And then the 1 year, 3 year, 5 year, and 10 year is the average annual return on the fund shares for the periods indicated. So that's C. And then that is it. Come back next time and we will start talking about Unit 4D. See you for the next video.